Kyle. Very good to see you. I want to talk about the recent market volatility and sell-off. As you know, the S&P is down around 13% for the year right now. The Dow Jones recently hit the eighth consecutive down week. The last time that happened was during the Great Depression. And just to put a finer point on it, take a look at this chart from FinViz. This shows the S&P for the past month. When I see all this red, Kyle, what am I supposed to do?
Right. I think if you're any investor in this market climate, you need to take a look at your whole plan. What is your portfolio supposed to be doing for you? And I think also you don't want to panic. You don't want to rush and make a bad decision just because you might be frightened. One thing that I look at all the time is the VIX, right? That's the volatility index,
Right.
or as some would call it, the fear index. And the little rule of thumb you can use on the VIX is you take the VIX and you divide it by 16. That can be, to a relative degree of confidence, your expected daily move in the market that day. So if the VIX is, for example, right now it's at 25, 26, but if it was at 32, divide that by 16, that's 2%. So we're looking for a 2% move any given day. That's an unreal level of volatility. So that tells you what we can expect from the markets, kind of week to week. And we're expecting this level of volatility to continue. There's a lot of stuff going on.
Wow, Kyle, that's so cool. You're teaching me something new. I had never even heard of that before. That's awesome. I do want to hit on something, though, that you mentioned and something that you and I have talked about before, which is behavioral finance. I know you are a student of this. You've studied the 30 years of data. You know that when markets are in the red like they are now, people tend to panic and sell precisely when they shouldn't.
Exactly. And that's such a common mistake.
Right.
And when, for a while there, like you said, it was just week after week of negative,
Right.
it can make you feel hopeless or like that it's the end of the world and let me get out while I can. And the people that feel that feeling the most are usually the ones that are not invested aligned with how they need to be invested, to be frank with you. So, if you're chasing high returns or trying to chase the lottery feeling of, I can strike big on this stock, you're going to start having those feelings of like, hey, I need to get out, or I need to reposition immediately, when that's not always the best choice. So at the end of the day, what we're going through right now is a transition in the economic cycle. So, we've obviously got challenges and a long list of them, but we knew this was coming to a degree. We just didn't expect the level of volatility that we see day to day.
Right. And it still hurts because we are human,
Oh,
as
yeah.
you know. And something else that you and I wanted to talk about, this chart is from Brookstone CIO, Mark DiOrio, who basically, Kyle, what you're looking at here is a $10,000 investment over a 15-year period. And if you try and time the market, if you try and pull out when the market's bad and then get back in when they're up, well, we know those good days are smushed up against those bad days. Look how much money you're losing out on.
I know. And that's 15 years of data, right? And it shows that if you miss just the 10 best days, I mean, your return is cut in half and then some over 15 years. So for us, it is not about this is the hottest stock right now, or this is the hottest investment right now. It's all about balance and long-term market participation, because that is how our clients are seeing success in their retirements on a general level. It's the risk appropriate investing, I think, outweighs market timing.
Right, of course. I do want to talk about a few more specifics, though. According to Bank of America, it's time to load up on consumer staples. The firm said the market is pricing in a 1 in 3 chance of a recession. So what does that all mean?
So I guess one way to look at the market is a forward-looking instrument, right? It's trying to price in the economy kind of in the future, right? So it's looking ahead. And if we start throwing the word recession or economic slowdown around, what do you think the market is going to do, right? It's going to sell off. It's going to lower the perceived value of those asset prices, like the stock prices. And so it's a classic move to get more defensive, right, when you see volatility or the VIX being really high. And so consumer staples, utilities, and healthcare are usually sectors that investors will move to get more defensive, kind of in light of an economic slowdown, because people are still going to need to buy cereal, right? You're still going to need to buy paper towels, or you're going to need to keep the lights on at the house. There's going to be capital going into those sectors.
Now, meanwhile, other experts are advising investors to be defensive. So what does it mean to be defensive as an investor?
Right. And that's kind of going back to the positioning of your portfolio. if you're starting to load up more on the consumer staples and get out of the high flying growth, that's exactly what that means. And so for us, it extends beyond just the portfolio. We're looking at asset allocation across a retirement plan. So we want to make sure that not just your specific one account is set up the right way, right? We want to make sure that every one of your assets is working together to, in our case, we deal with a lot of retirement clients. We want to make sure that all of their assets are working together to ensure that that retirement works.
I'm glad you brought that up, because I would like to ask, how is any of this advice different for somebody who is in or near retirement?
Right. So if you're younger, right now, some things are on sale. You
Yeah.
can look at it that way, right? So some of these things have really gotten hammered, and there is a chance that they will recover handsomely. You know, in the interim, we'll see how it goes. But near retirement, you really got to think, okay, is now the time for me to get aggressive and try to make a few quick bucks? Or do I want to make sure that my plan as a whole is serving me properly? And I think this is a good wake up call for those that are feeling really scared, because if you're feeling really scared and uncertain and time to sell, then you're probably not invested the way that you feel comfortable with being.
Right. And that is such an important question to ask yourself. So somebody is watching this video and then has that question. Kyle, what's the best way to reach you?
The best way to reach us is through our website, firstcoastfinancialgroup.com. You can book an appointment right on there.
Yeah, it's very easy. All right, Kyle, thank you.
Thank you, Erin.